Vasuki? Vasuki?
Yeah.
Hi, Vasuki. Did we start the webinar?
Yes, we have started the webinar.
Okay.
The speaker is joined as a participant.
Okay. Let's just check. Yeah. Okay.
Yeah, he's joined in.
Yeah, can you hear me now?
Yeah, I can hear you, Mr. Ramasubramanian.
Yeah, okay, good. So I'm able to hear you too.
Okay, sir.
Okay, can
Yeah.
you share your screen possible so that we'll
Video,
just have a
right?
quick check before we start?
Yes, sir. That would be nice. Thank you
Yeah,
so much.
is it
sir.
okay?
Yes, sir.
Yeah, it's fine.
right.
I'm really sorry that you had some difficulties in joining.
Yeah,
I
because
believe.
it threw the registration screen on me, so I was not sure why. So
Oh, but Adarsh had already registered, giving all
yeah,
the
he
credentials.
did
of
say
yours.
that, but he also got the same problem when he tried. Yeah.
Okay, my apologies for that.
No
for your
issues. No
inconvenience.
issues. So I
Okay.
just wanted to check. Participants are not yet in, right?
They're already in.
They're
All
already
right.
in.
All right. Okay.
Yeah. So can I go ahead,
They
sir?
can hear us.
Yeah.
Arjun, 1 second. When the participants raise their hand, you allow them to speak. And
Okay.
then you have to lower their hand.
Okay.
Till then, they can hear and view the program. You got it?
Understood. Understood. And
Go
also
ahead. Huh.
the questions can be asked right at the panel. Anyway,
Through the chat.
I'll
Through
just
the
go
chat,
ahead.
they can ask a question, raise their hand.
Okay.
You just tell them that this is the house rules.
Yes, understood. Okay, Vasuki.
Just ask them to raise their hand if they are able to hear us.
Okay. So, hello everyone. Good afternoon. I request everyone to just raise their hands if you can hear us clearly. Yeah, that's a good sign. Okay. Okay. I guess so. I guess we are good to go. Yeah. Anyway, good afternoon, everyone. Very warm welcome to everyone here. My name is Arjun, and I'm excited to be the host for today's workshop. Today, we will jump into the shoes of an investor and learn firsthand on what investors look for in a startup that is raising their pre-Series A funds. The best part is that we're going to learn this straight from one of the most celebrated and experienced angel investors within the Indian startup ecosystem, Mr. Guruswamy Ramasubramanian. Mr. Guruswamy Ramasubramanian is a general partner of SiriusOne, which focuses on investing in promising entrepreneurs solving big problems. Over the last 3 decades, Mr. Guruswamy has helped more than 10 companies to grow multifolds in various dimensions, growing customers, employees, as well as geographical locations. Within the 3 decades of his IT career, he started his own IT firm, grew it over a decade, got funded by VCs, and also finally sold it. In the past, he has worked with eminent organizations such as Tata and IBM, also served as a CEO to an international fintech company. Could just go on, sir. However, we don't have so much time. So without further ado, let me hand it over to Mr. Guruswamy Ramasubramanian. I request the audience to drop in any of your questions that you get during the session at the chat box, and Mr. Guruswamy will pick it up during the session or maybe at the end. Thank you, guys. Sir, the floor is yours.
Hey, thanks, Arjun, and it's a pleasure being here. So, Arjun, just wanted to check if the participants are muted or they are not. I mean, I just want to make sure that there is no external disturbance on the call.
They are muted.
All are muted, sir.
All are muted. Okay, thank you so much. So, but then please feel free to raise questions on the chat box, and we will do our best to respond to them as well.
Will do, sir. Yes.
Yeah. Thank you very much once again, and it's great to be part of the NASSCOM. Under the NASSCOM umbrella, I've been here a couple of times before, and I've been truly excited about this, possibilities and also the healthy quality of interactions I have had in the past. I'm sure this call will follow a similar, experience for me.
Yes,
so yeah, so thanks, Arjun, for the great introduction. Though I am still an aspiring entrepreneur, just wearing a different hat. That's all. So, from that perspective, you people on this call can think of me as one among yourself. It's just that I am on the other side of the table, but I am every bit an entrepreneur like you, because I go out and sell my fund, raise money, and then the only thing I do is obviously to invest that money in companies such as yours, right? So that is the only difference. So I'm not a different, a different person in that sense. Okay, so let's take it from there.
Yeah. So we are all in the same boat.
Absolutely.
That's good. Okay.
Absolutely. Yeah. So I know Arjun and his colleagues have been asking to talk about this topic on what does an investor look for. So I think from the short introduction that Arjun gave about myself, I have also been an entrepreneur for about 10 years in my career. So I know what it is like. I mean, it is not very pretty, right? I know what it takes to go through the process of trying to grow a company from zero to whatever size it may be. And every step is, while it is exhilarating, it is adventurous, it is also very, I would say, draining in terms of energy, in terms of your ability to last the distance, in terms of what it takes to go through a series of no's. The no's can come from anybody. It comes from your the people that you are trying to hire, because they don't think that you are good enough to be work for them to work for. The no can come from people you are trying to sell your product or service to, because they don't want to depend on a company that nobody has heard of before. And they are there, and they obviously have the problem that what happens if they trust in your product and tomorrow you go bust. And the no's can come obviously from investors, because they don't think that you are good enough to trust their money with, right? So it comes from various quarters, and then it takes a tremendous amount of challenge and the kind of ability to withstand that kind of pressure on a day-to-day basis, right? And so I respect all the people here on this call who have thought or dreamt of starting up a company, have already done something, have already started growing a company, and so on. So I have a lot of respect for people. At the same time, I also truly believe that this is the only way somebody can create value, right? It's always easy thing, I'm sure that any of you on this call could have, taken a job in some other company and worked for a few years, maybe for your entire career. And probably you would have been financially better off at this point in your career, if you had taken some other option. But why did you choose to do what you're doing today? It is because, number one, you have a long-term view in mind. You are not building something for today and you want to get out tomorrow, right? You want to build something which has got lasting value in the eyes of customers, in the eyes of society. Obviously, there are financial rewards that go with success, right? That is something that you take it for granted, but that is probably not your primary motive in starting up a company, right? You know that you have something unique to offer, a solution for a problem, and you are convinced that what you're trying to build is something that customers will be looking for. That is what brought you here, right? So it takes that kind of a attitude to last the distance. And you know all these statistics around how many companies succeed, how many don't succeed, and all of that. And despite those odds being so heavily against you, you have chosen to build what you're building. So I think you truly have to give yourself a pat on the back, right? So I truly believe that. Okay. Now, as an investor, you're saying, what does an investor look for when I am going and talking to this investor about my product or my service, my company, my vision, etc. Right? So I can give you a few things. These are not rocket science, and especially if you have been in front of a few investors, you probably have that checklist by now already, and there is enough information and more on the net which you can access, mine, and be prepared for such discussions. But from my perspective as a professional investor, right, there are all kinds of investors. You talk to different flavors of them as you go along in your journey. As a professional investor, is somebody who is basically getting money or getting other investors to trust in this particular professional investor's ability to deliver them a higher than market return for the money they are investing in this particular professional investor. So that is the difference, right? If I am having a ton of money myself and I am investing as an angel investor in a startup, right? I may or may not be benchmarking my investment against other channels. I may just be doing it because I believe that a part of my portfolio I can risk investing in startups, right? But a professional investor cannot take that kind of an attitude because they are dealing with other people's money, right? So there is a pressure on professional investors every bit as much as what a startup entrepreneur has to deliver value to the investors from whom this professional investor is taking money from, right? So you need to understand that, and out of that will come a lot of understanding as to why professional investors behave the way they do, right? Because they may not always behave or react in the way that you would think they would be reacting, but there are these other pressures on their shoulders which causes them to kind of react the way they do, right? So it gives you a little bit of understanding of the other side of the table, and I think it also probably equips you better when you go out and talk to them. Okay, so the first and foremost, I think what I would look for in a company, because we are a fund, a SiriusOne Capital, which invests in anywhere in between seed and a series A kind of a stage of companies that are looking to raise money. Okay. So at that stage, the thing that is looking on, see, we don't have too much of data, right, to look at what you have done in the past. Maybe as an entrepreneur you may have some data because this could be your second venture or the third venture or something like that, so there could be some personal history you have accumulated as an entrepreneur. Could be successful, could be failed, does not matter, but what is the kind of experience that you have gone through is something that we would definitely be interested in looking at, right? But as a company, you probably have little or no data to go by. So we are not investing in the listed company space where if I want to invest in shares of Tata Steel, I have 100 years of data to look at, right? What have they done in the past? How have they delivered across business and economic cycles? I can have so much of analysis done, and then I know whether I want to invest in this particular company or not. Whereas as a startup, I do not have that luxury. There is nothing much that I can rely on, right? So it becomes a lot of, I would say, intuition that needs to be there on the part of the investor to take a call on whether to invest or not. Obviously, one of the key ingredients is about the quality of the founding team, I think, which is probably the highest when it comes to in taking a call on investing. So the quality of the founding team is not just a profile, right? That you can go by. It's not a professional resume that you submit, right? Because I'm not looking to hire somebody for a job, right? I am looking for certain entrepreneurial characteristics because that is what I know is going to help this company. Okay, you may be good in what you do. You may be a technology guy if you are coming up with a technology solution for your, your startup idea. You may come from with a lot of domain experience. You may have worked in, say, fintech or banking or hospitals or medical healthcare systems and so on and so forth. It's quite possible that you bring a lot of that experience with you. Those things, of course, matter in the sense that how closely are they related to the idea that you're pitching for. Is something that is relevant. But more important than that is your qualities as an entrepreneur. Have they been tested before in some other context, right? How have you fared in those tests, right? It could be another startup. It could be your own family situation. Many of the entrepreneurs I talk to come from challenged family situations. They have risen to where they are because they have struggled against enormous odds to come to where they are, right? And that to me is a very, very important point. Somebody who can show that kind of guts, that kind of fighting abilities is somebody who is probably well equipped to become an entrepreneur, right? So you look for those kind of characteristics, right? Have you participated in any team activity, for example? Have you been a follower before you can become a leader, right? Because that's very important, right? You cannot lead unless you are an effective follower. Okay, that is something which is very, very probably is a truism, but that is correct. So how can you really understand what a follower looks like unless you have been one, right? So you need to go through some of those thinking when this is all the things going on in the investor's mind, right? When you are pitching, right? Obviously you are pitching an idea and you are going through the standard slides of a startup and so on, but underlying that I am looking for these kind of signals. It may be there in your deck, it may not be there in your deck, it may come through in your body language, in the way you respond to the questions that happen after the presentation, right? I am looking for transparency, right? I am looking for honesty, right? I am looking for somebody who has the guts to say, I don't know, right? So, sometimes, investors ask questions, and, when you see quickly ready-made answers flowing from the guy, you wonder, right? I mean, is this possible that, this guy seems to have all the answers in the world, right? So do you have the intellectual honesty to say, I do not know, right? And that, I think, is something very, very important, right? Because we don't think it is the one person's idea that takes it all the way. It is a team. Teams have to collectively find answers to solutions. You may still have the kernel or the core of an idea, but that's not enough to make it successful. Many people have to contribute to it as it goes forward. And at every stage, you are going to be hit by so many unknowns, right? And you should have the intellectual honesty to say, now, I don't know, guys, let's put our heads together, come up with a solution. Okay. So these are things that I look for. So that is one of the key things, the entrepreneur, the founding team, so very important, right? The founding team brings another dimension to this whole thing, because, you imagine, an investor, suppose he invests a $250,000, $500,000 in your company. On what basis is this person investing, right? What is the guarantee that the entrepreneur, after having accepted the money, tries to, after 2, 3 tough quarters, decides to say bye, right? I am quits, right? Guys, leave me. I think I have a good offer from, XYZ company.
Yeah.
Okay, I'm going, and, I will leave the others to deal with this mess. Okay. Now, what is the recourse an investor has? Pretty much nothing, right? So you have to think about some of these. These are risks which come inherent in startup investing, and this has happened. This is not fiction, right? This has happened in the past, where founders have thrown in the towel. You could even have something unforeseeable happen. Founder has an accident, he's injured badly, he dies. What do you do, right? So you need to think about the founding team, right? How complementary are the skills of the founding team to each other, right? Are they able to collectively pull it off, right? And this is so very important. Just, if you don't have a co-founder, I would really urge you to look for one, right? Because you will need that support. It is not just about building something together, it is about having a shoulder to lean on, because you are not going to have smooth sailing along the way, right? You need to have somebody with whom you can have a very transparent relationship. Okay. And that is so very important. And find somebody, in many cases you already have somebody, comes from your college batchmate, or somebody with whom you worked, and so on and so forth. But it must be, so a couple of critical things there, right? Have a very heart to heart discussion with that person. If you are exploring an idea together as a co-founder, right? What are you looking for, in this thing, and what is he or she looking for, right? Have the discussion upfront. We find many cases where they come together because it is more like a transactional thing. There is not much of emotional connect between the founders, right? And then they come together and they know that, when the first thing hits the fan, maybe it will break one of them, right? So you don't want to end up in that situation. This is like, I would probably call it like a marriage, because you want to be together, right? And you want to be together through thick and thin. Okay. At the end of the day, whether it is successful, whether it is failed, you both go back wiser from the experience. Okay. So, and then maybe the second time clicks for both of you. We have seen this happen as well. Founders who have started a startup, did not go well. They both, went on to do something else together, and that clicked. And why did the second one click and not the first one? We do not know, but clearly the first one gave them so much of experience in dealing with, problems, that it put them in the right position for the second one, right? So how do you really come up with a founding team is something that you really need to grapple with, because that is important. Having a co-founding team gives a better profile to the investor too, because he sees that, there is a team and not just an individual. And secondly, if there is complementarity on skills, it really helps to present a better picture. Okay. Then the other thing is about the market size. This is a problem that I find in many startups, right? They say that, oh, this market is, humongous, right? $500 billion. Okay. And I'll say that, I will capture 1% of this market. Okay. And this is a typical slide you find in the startup, decks. And because of this, my business can be like $50 billion, whatever that number is, right? And this completely puts investors off, right? Because you are not in a 500 billion market. Let us be very, very clear about it. Okay. And you will never be, unless you become, like a 20, 30-year-old company, right? So understand the market where you are entering, where you are trying to claim it as your own, and be very, very precise in defining that particular market space. Okay, so very important. Okay. And the reason I'm saying this is you cannot fight battles on multiple fronts, right? You have to choose your battle, and in that battle, you should have the probability of winning, right? And in typically any large market, there are so many sub markets which are hidden there, which you may or may not be aware of, but you need to take the pains to understand what those sub markets are. Because once you go down to that level, you will find that every sub market has got its own competition. Okay. So it is not the global or aggregated level competition. Everybody puts up a competition slide and then says they don't have X, 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 X. I have all tick, 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 tick. Right? That's it. Okay. I mean that is very superficial in my opinion. So you need to understand the market at a very sub segment or even sub segment level. Okay, and then at that level, what is your value proposition compared to what the competition has? It's so very important. It also helps you to refine your thinking, and there are many other benefits because of this. Because in a moment you define your market in a very crisp and binary way, it means that your product and service or whatever that you are coming up with can be extremely well focused. Okay, so you do not try to be everything to everybody. Okay, so that is a sure recipe for failure. Okay, so you choose the sub market or the sub market and then say, in this particular market, which probably is probably 1/100th of the total market size I'm talking about, in this particular market, this is the competition and these are their offerings, and this is how I am going to compete and win in this particular market. So once you define that, your product becomes crisper, your capital, look at this, so you are not, you don't have access to unlimited amounts of capital. Okay, so your capital needs to last the distance. Okay, I have seen so many, sad stories. Companies who have been successful in raising one round of money, they ran out of money before they hit a milestone that they had planned. Okay, and now what can happen at that point if you were to be in that situation? Either somebody comes to your rescue to pull you out and give you that extra mileage and extra money to go to the next stage, or typically you will have to shut shop. Okay, because you have not proven that you have scaled enough to attract the next level of funding. Okay, so the more crisper you define your market segment or sub segment, you need lesser capital to go after that. Okay, so which means that you can raise less. What does that mean? If you want to raise less, then you dilute less. Okay, so there are so many benefits by doing this. Okay, so keep on revisiting this marketplace discussion because this is going to be a key one for you, and it is going to drive many other decisions. Okay, so that is something that you would really keep in mind, and that is something that I am looking for as an investor as well. How well do you know this particular market that you are trying to enter? Okay, then obviously the next one is the product market fit. Okay, it is so very important. Okay, so and there is no one common definition for what that is, but typically it is the point at which you get the feeling, and there is some data to back that feeling, that you have a product that the market is looking for. Okay, now there have been some statistics about startup failures which says that 60 to 70% of startups fail because the market did not require their products or services. Okay, and this is the primary cause of startup failures. You went ahead with an assumption that the market requires my product, and you have devoted time and energy to build something, and then you realize that the market does not require it for many reasons. Your initial assumption is wrong. You didn't build it right. You are not solving the most important problem. You did not market it right. Whatever could be the reason, right? Ultimately, the thing is the market either does not know that you exist, or even if it knows you exist, it does not care about your product or service. That's the single most important reason for startups to fail. Okay. Now, how do you avoid this risk? Right? Is about going to the testing the product market fit as early as possible. Okay, this is so very important. Now, I had a startup guy who came to me. He is in the US, senior professional. Okay, I was very surprised. He has spent 4 years of his life developing a product, and he has employed a team of about 20 to 30 people in India, and he has developed a product. It has all the bells and whistles. It has got video conferencing facility. It has got social network media facility, features, everything bundled together. It has got mail, it has got this, it has got that. It comes with, it's a bundle of everything. Mail plus Facebook plus WhatsApp plus Zoom plus whatever, right? 4 years. And then he said that this is the product, I want to raise money. Okay, now I asked him, how many customers have seen your product and what have they told you when they saw this product? He has said, I have not shown it to any customer yet. Okay, to me it was astounding, to say the least, right? Because this is not small money we are talking about. This guy has been working on the side. He has been putting his entire savings into this product for the last 4 years, and he has not shown it to a single customer. Now, to me, that is a recipe for disaster. I mean, absolutely. I mean, obviously, as an investor, you cannot, I have to be polite and say that, boss, first show it to a few customers, see what they're saying. Okay, show some of the features of this product. It looks very cool and interesting, but finally the customer has to validate it, right? So if you're developing a product or a service, the earliest possible time you need to do something, do it and be in front of customers. Okay, and that is so very easy these days. Okay, it is not so difficult. But unfortunately, one of the problems I'm seeing is with technology based or technology led founders, they hesitate to put on a salesman's cap. Okay, they do not have sales or marketing skills. Okay, and so they think that they can hire these skills. Okay, and that is probably a huge mistake. Okay, if you are not able to articulate the value of your product yourself, how do you expect somebody who you are hiring to do that as effectively as what you can do, right? So you have to go out and sell the first whatever 10, 15, 20, if it's a B2B, if it's a B2C, the first 100, 500 customers, you have to sell it yourself. Okay, there is no shortcut, there is no roundabout on this. You have to do it yourself. Okay, because that is the only place where you can validate your assumption that this product is good for a customer. There is a customer who's willing to pay money for this product. Okay, and this to me, for any investor, is a huge plus point. Okay, if you have X number of customers, when you approach the investor who are already paying something, it need not be market price, it may not be something, but you just imagine how difficult it is to get a rupee from somebody's wallet. Okay, you can imagine. Can you do that? Can you do that, right? Without saying that I will give you something in return. Okay, so this is the place where rubber hits the road. Okay, so you have to say, I need 10 rupees every month, or whatever, $10 a subscription every month for this particular SaaS product, and this is the value you are getting for the $10 that you are paying me. Okay, and if you have 100 customers saying, yes, this is worth $10 that I am paying you every month, you have a win on your hands. Okay, and this cannot be short circuited, this cannot be delegated, this cannot be outsourced to Facebook or Google to do digital marketing, nothing. Okay, you have to go out and do it yourself. Okay, and not only that, it validates, there may be so many assumptions that you are making in the course of developing a product that may or may not be on track, right? And this gives you a chance to validate all of that. You may think the top 3 features are something, let's call it A, B, and C. You show it to 5 customers, and then at the end of 5 customers, you say, oh, A, B, C is not even on their list. They are looking at something else, E, F, G, which is not in my top priority. Okay, now, so this is an opportunity for you to course correct. Okay, you can say that now I have to reprioritize. I have to put more effort into developing these features versus these features. Okay, so there are so many calls that you can take because you are going early to market. You are, in a sense, they call it fail fast. Okay, it is in the worst extreme. You go to 100 customers and everybody says, I don't want this product. That you probably do not have a chance or a successful product with you. You can at least shut down that company or the product early enough and go on and do the next thing, right? So why do you want to waste years of your life chasing something in the mistaken belief that there is a market out there, right? So product market fit, so critical, so important, and something that founders have to do that yourself. Till you arrive at that point, don't outsource, don't delegate, don't do anything, just get it done. Okay. And also, if it is a a B2C, B2B, whatever kind of a product, look for customers who you do not know. I think the temptation is always there to first talk to your friends. Okay, I'm building a B2C platform. Hey, would you be interested in using it? That guy probably wants to be very nice to you, so he says, oh look, tell me the link, I'll download the app or whatever, right? So you build a base like that, it's not going to help you. Okay, how many of these people are people that you do not know? Okay, who you do not know, they do not know you exist. You have established first touch with them, you have talked to them about your product, you have onboarded them into the product, and they are paying you for the product. Okay, so that is important. So eliminate all the people in that group who are your direct, your uncle, your family, your fiance's father, whatever it is, right? So don't rely on that group, because they're probably being very nice to you. So be hard on yourself, right? So that the rest of the journey can be easier, right? So that is one thing. And also many companies invest very quickly on technology, right? Probably good to have a straw man, to have some limited set of features in a prototype and so on. But don't try to put more money into technology in the assumption that it will solve your fundamental problems. Okay, your product market fit problem will not be solved by putting more resources into technology. Okay, you have to address it at a different level. Okay, so in many cases it would make sense even for you to do it manually. For the first 15 customers or 20 customers, don't even tell them that you have a product. It has happened in the past for many startups like that, where if it is a B2C or whatever, they may just use an Excel sheet on the back end and pick up the phone or WhatsApp on the front end, and you establish connection with customer, move product, sell product, you collect money through one of these payment gateways, which you can set up with pretty much less lead time. And they have been able to crack that by proving that the business model works. There is a product or service that can be sold, and then went ahead and built the technology around it. Okay, so see if you can do that as well, right? And there's one famous saying which says, you probably need to do things that do not scale initially to ensure that you get a business that scales. Okay, I don't know if you understand what I'm saying, so I'll repeat it again. So it says that founders do things that do not scale in the beginning, so that they get a business that scales in the end. Okay, I'll give you an example. When in the early days of Airbnb, when it was just a very funny looking site, which just advertised some places that people could stay. The founder of Airbnb, he went with a camera on his shoulder, right? He was living in I think the San Francisco. He moved all the way to New York because somebody from New York had put up their home, saying that we would like to welcome guests into this place. So but then the photographs that they had put up were not good. Okay, so he took a flight from the west coast to the east coast of US with a camera on his shoulder and another colleague, and then they went and knocked on the doors of this home in New York. Okay, and then when those guys opened the door, he said that he did not say that he was the founder of Airbnb. He said that I am a cameraman who this company has hired. This company called Airbnb. Apparently, you want to put up your house for hosting guests. That they have put it on the site, but the photographs are not very professional looking. So we would like to help you by taking some professional photographs and then put it up on the site. Okay, and for which we will not charge you. Okay. So obviously they let him in, and then they into the place, and then they let him take the photographs. So he took photographs professionally, with a good camera, and then that's what he put up on the site. And obviously, they probably got some guests, etc. And he did it not just for one house, for many houses he did. And this is important, right? So you see what I mean when I said, he cannot do it today. If Airbnb's, founder wants to do it today, you probably be roaming around the world for the next several years to do that. And he probably doesn't need to do that too, right? But he did it in the initial days. He did not mind getting on a flight, taking a camera, knocking on some stranger's door, claiming that he was a professional photographer, taking the photographs and putting it up on the site of the Airbnb, right? Because he knew that that was required at that point in time in the life cycle of the company to help it to scale later. Okay. So in your context, in the product or the service that you are building, what is the equivalent of this? You need to think about it. What can I do for my first set of customers where I go above and beyond whatever I have promised them, so that they feel that they are emotionally connected to this product and they cannot survive if this product were not in the market. Okay, so you need to think about that. So very important. Right. So that was another point I wanted to touch upon, because this is critical in helping you to scale the business. Okay. Then let me think about a couple of other topics which could be relevant. One is about people that you may want to hire. The first, depending on the size of the company and what you think is required, the first hires into a company can, again, very similar to what I said about customers. Anybody that you hire, you treat them like an internal customer, right? And the first few hires that you have, they actually should be treated like co-founders. They may not be co-founders, they may not have the kind of equity in the company, or they may not have the ability to take risks, etc. But from your point of view, from the effort and the care that you take in picking that initial set of people, they are every bit as important as a co-founder to you. Okay, so you need to go deep into that psyche of these people. Why are they joining you, especially if they are good? What is in it that kind of attracts them to your company when they have the world at their feet? I mean, they can go join anybody else. So why are they joining you? What is their motive? What do they bring? Do they have all the qualities that a founder should have, right? Because this journey is going to be rough. Are they prepared to last the distance, right? So you need to go through that entire process for every single hire. Here again, this is not something you can outsource to somebody in HR or some external agency. Hey, get me to a guy with 3 to 4 years of experience in Java script and whatever the latest technology tools, and then we will hire them, right? It is not that. It is about finding people, stars, who you want to be with in this journey. So first, you decide the number, 10, 20, 25, whatever number, but you need to be there. I'll give you context. Netflix, my cousin's husband works for Netflix. He's a senior engineer there, and he was one of the early people who Reed Hastings himself hired when the company started. Okay, and he says that Reed Hastings knows the first 400 employees of the company by name. He knows their family. He knows what their spouses are doing, where their kids are studying. I mean, it's not that he memorizes them, etc., but he has made it a point for him to know about those people, so that when you very typically, he says, when you run across him in the coffee machine or in a conference or in a meeting or something, he will just suddenly come up and say, "Hey, how's your son doing? The last time you spoke to me, he said he had this problem, or he was doing this particular study. Has he completed it?" So he says, "I'm amazed that he kind of remembers this, right? He's talking to so many people, he's interacting with so many people on a daily basis. How is it that he remembers my son's name? How is it that he remembers my son, what he is studying, and what did he hear about him last?" Okay, that is the care. And you know what? The first 400 employees of Netflix never left him. Okay, and it is not an accident, right? So when you feel that your boss cares about you so much that he makes it a point to know your family, etc., you feel that you are part of this larger family, right? And you would really think twice or maybe more before you decide to leave, right? So if you are hiring people out there for the founders and entrepreneurs, make it a point to understand the people that you are hiring, and you should know them better than they know themselves. Okay, that is a goal or an objective that you can strive for, right? That is very important, because they have this is a journey, and they have to be with you for the full length, right? So important. Okay, so that is one thing. And finally, I think we are probably having Q&A in another 5-10 minutes, but let me round out with a couple of points. One is about the discussion about the equity and valuations, because every startup founder is grappling with this problem, right? Number one, you should have a lot of conviction. I don't need to say this. You should have a lot of conviction about the product or service that you're trying to build. Okay. So number one, so because that gives you the confidence to start talk with an investor. Okay. Number two, you should have a fairly good understanding of what is happening in the world around you. I'm sure there is no business which can stand up and say I have no competition, right? And these days, competition exists everywhere. Everybody is having an idea. Some people are raising money. So you should have enough information at your fingertips on what is happening in the world in terms of competition. What are they raising? Who is funding them? At what valuation are these being funded? At what stage are they being funded? You should have all of this information, because the investor will also have this information. Okay, so there is no secrets over here. So you should understand that, so that when you go to the table for a discussion, you are well equipped to have the discussion. Because I think one of the, especially if you're dealing with professional investors, okay, you should understand that they are not out there to, cheat you out of your hard work. Okay. The investor wants you to be successful. The investor wants you to add value to the money that the investor is putting into the company, and they are willing to take that risk. As I told you earlier, the enormous risk that they are taking, obviously they want to see that the investment grows multiple times. Okay, so it's a fair expectation. But at the same time, obviously there are all kinds of investors out there, so you have to be also on your guard. You cannot assume that every investor is coming with the best of motives into your discussion. So you should have the information at your fingertips when you go in as to what is going on around the world, in the world around you. Okay, so that is one thing. Second thing is equity, right? You have a beautiful currency, which only the Reserve Bank of India can, print in India, right? And the founders of every company have got a currency, and that is called equity. Okay, but unfortunately, unlike the Reserve Bank, which can keep on printing currencies, you only have 100%. You can only give away 100%. After that, you don't have anything more to give, right? So how much is it that you think you should give away, and what are you getting in return for that? Okay, so be very clear in your expectations when you talk to investors. Do the homework before you get into discussion. I'm sure every investor out there has got a profile, have got a a web page, have got some history, understand what kind of companies they are funding, what are the terms in which they are funding, whether they've gotten exits, are there other companies that they have funded, and do you know the founders of any of those companies? Can you talk to them before you get on a discussion with the investor? So it is about you doing due diligence on the investor as much as the investor does due diligence on you. Okay, so be prepared when you go into these discussions, so that you can have a productive discussion. So, okay, the equity, as I told you, is only 100%, right? So you need to be careful about how you ration it out. Obviously, you are in it for the equity, right? You are in it. You are not in it for the compensation or the monetary benefit, because you may not even get a salary for the first couple of years in this business, right? So if you are in it for the equity, you should have adequate equity, in your name when hopefully there is an exit, organic or inorganic, whatever the case may be. So you should be protective of that. And there are other contenders as well, your key employees, your co-founders, your friends and family who have bootstrapped your company, could be angel investors, then comes the professional investors, right? So all of them have a stake in the company, and you should be clear about what you can give, and more importantly, what are you getting in return, for the equity that you are giving away, right? So it has been a very bitter experience, when you talk to some of these founders who have just gotten financial investment from somebody who does not understand the business. Okay, and that has happened in the past. I've seen many cases of that, where this person may be a old wealth kind of a person, right, who has got a hereditary wealth, or they may be coming from a completely non-technology background. So they expect, they have read somewhere that, a company has been a unicorn, it has got $1 billion valuation. So they say, oh, let me invest $1 crore. and the next 2 years, this company will become $1 billion, my 1 crore will become 100 crores. Okay. Now, if that is the expectation with which somebody is writing out a check for you, I would suggest that you think twice or thrice before accepting it, irrespective of what the pressures may be, because you're probably inviting more trouble. It is not worth the money that that somebody is giving you. Okay. Understand the investor expectations very clearly before you sign up for something, right? Because you don't want to be spending the next 2 to 3 years of your life, and every day this guy is calling you and then say, hey, what happened? Why are you not a unicorn yet? Okay, you don't want to face that question every day of your life after you received some money from somebody. Okay, so do all of that and ensure that you put a fair ask on the table. I also see that some of the startup founders, they're kind of carried away by media reports and other things, and say that, okay, my valuation is this much, right? So no, and then investor says, why do you think its value is so much, right? And the startup founder says, what, this guy raised money at this price. So that may or may not be the yardstick for you. So you need to be clear about, ultimately look for a win-win kind of a deal. That's what I would really request you. And because there is no hard numbers or hard valuation or a hard thing that I can tell here, but only thing is respect the other person and ensure that you don't give up beyond a certain line that you draw for yourself. If it is not acceptable, be courteous, walk away from a deal, because this is a very, very networked world today. Okay, so even if you may not sign up a deal today, there is nothing that says that you may not again come across a table a few years down the line and have a productive discussion tomorrow. So better not make permanent enemies out of investors or any other community, because we live in a world where things keep coming back. Okay, so ensure that you leave on a pleasant note. And also ensure that many times this is also good practice. If somebody is also saying that I have, this is a common response from investors, you probably have heard, you are too early. You may face this response, you are too early, so we are not investing in companies at this stage. We are looking for investments or companies that are further down the line, right? So walk away. There's no point in carrying on further conversation. But one of the things that you can do is to keep that investor updated. I have seen very, very few companies coming back and updating me about how they are doing after we have a conversation which is not leading to an investment. Okay, and you can be an exception, because that will stick in the investor's mind. You can say, this quarter we did this, that quarter. So you keep pushing this information out. Keep a proper record of the people that you have been talking with, investors. What are they saying when they turn you down? Note it down clearly. And if you are able to close one of those gaps, somebody could say that your product is not mature enough. Somebody could say that I don't like the pricing of your product, whatever that may be. So keep on sending out information back to the investment community or the investment teams, so that they understand that these guys are serious about what they're doing. And the next time you approach them for a funding round, you don't go in as a outsiders, because they are fully informed and updated, and you can have a good starting point for the next discussion. Okay. So quite a lot of things that we can keep talking about, and hopefully I try to cover a few which came top of my mind, and which I come across in multiple situations. So I see that there are a bunch of questions, and maybe we can go through the questions now. Arjun, are you going to help me with the questions, or should I read up the questions myself?
Yes, sir. I'm right here. Thank you so much. So let's go straight to the questions. So we have Bharat Kumar Hegde posing the question. What is the difference or the similarity in approach between being market ready or being investment ready? This is in focus for a health tech startup.
Sorry, can you repeat the question again, please?
Sir, I think you can also see the questions on the Q&A. So there's Bharat Kumar Hegde on the first. What is the difference or the similarity in approach between being market ready or being investment ready?
Okay, being market ready and being investment ready. Okay.
Yeah, for health tech startup.
Yeah, I think being market ready is a function of your product readiness. Okay, so you can be market ready before or after being investment ready. But normally what can happen is, the logical sequence is market readiness. That's what I call product market fit, is something that you try to establish as early as possible in your journey. Okay. And if you have established that and you have some data points to show that, you are comfortable with that, the fact that you have established it, that is when you start becoming investment ready. Okay. But
Okay.
there could be investors who may be having faith in you as an individual even before the product is market ready. And typically this is your bootstrapping phase, because everything starts with an idea, right? I mean, you don't have a market ready product from day one. Okay. But somebody is investing in you. It could be your family, it could be close friends, and so on and so forth. And so they are actually investing in you before the product is market ready. But it does not mean that you are investment ready in the sense that, in professional investment. When you go to professional investment, they will look for signs of market readiness. It can be, it may not be let's take a technology product, for example. If I have a product which is, say, in a beta version with a bunch of pilot customers, okay, and they have been using it for, say, a month or two, and they have given me good feedback about the product, okay, and they are saying that, when your product is launched, I will convert to your customer. I would give a lot of faith on that proposition, saying that, this product is probably market ready. It is still not there yet, and there are a bunch of people who are using it and they are giving good feedback. It could be constructive feedback. It need not all be, great feedback, but it's constructive feedback. And then they also expressed the willingness to become customers when the product is finally hitting the market. So those are good signposts to, to talk to investors about. Okay. So to me, that is a good sign. Obviously, if you have a paying customer already, that is clear proof of, a market readiness. But again, like I said before, please ensure that, these initial customers don't come from you. I mean, they can be in your known circles, but, how many of these investors come from your circles outside the known circles? I think that is very important, because, they are truly looking at this product with dispassion. Okay. So they are not using the product because, they like you, right? So you have to be clear about that. Arjun, you're muted.
Thank you, sir. Thank you for clarifying that. I hope Bharat Kumar got his answer from that. There's also a question from Mr. Arjun Gupta. So this is a little bit more focused. So it's in the chat section, sir, for your Persuade. If you look at the chat section.
Yeah. Oh, it's in the chat section.
Yes, it's
please do share about SiriusOne focus areas, industry, stage, and size. Okay.
You look at niche but globally growing industry segments such as genetics.
Yeah. So yeah, so Arjun, thanks for this question. About having been in the IT, services business for like more than 35 years, I am comfortable talking about technology solutions to companies, and I understand the role that technology can play in the overall solution stack of a business. So that way, yeah. So we are focused on that. We are vertical agnostic, more or less. We can invest across verticals. As I said before, our stage of investment is between seed and pre-series A, right? And our typical check sizes are between 1 crore and about 4 crores. So between little more than $100,000 to $500,000. So that's what we do, and we are prepared to do follow-on investments to avoid the problem that I mentioned before of companies running out of capital. See, maybe one of the things that I should add here is that, companies typically are very aggressive in their forecasts. Okay. Whereas the real world does not work like that. Okay. So typically investors will tamper down the forecast. They may not just agree with whatever you say, I will double my sale every other month, is probably something that does not happen for many companies, right? So they will tamper down the forecast. What that really means is that the business is not generating enough cash to keep the business going, and you will need external cash. That's what it means, right? When the business does not grow as fast as what you project. So that could mean that either that you need more capital than what you think is necessary upfront, or somewhere down the line you will run out of capital and you will need to raise a bridge round. Okay. So investors don't want to be in the situation where they are underfunding a company, because that is a recipe for failure. Okay. So they will either say that, I will give you X dollars now, and I am keeping, say, some Y dollars, if you hit these milestones. Okay. then you become eligible for the Y dollars. That could be a good way of funding a company also, because the Y dollars which will come in later may come up at a different valuation. So you may need to dilute less, okay, rather than accept X plus Y upfront, which means that you will have to dilute more. Okay. So look at some of those equations when you start having discussions with investors. Okay. So that is the stage of funding and the size of the checks that we write. Ultimately the investor has to understand the domain in which they are investing. Okay, it may be very fancy to say that I am a deep tech investor and not understand anything about the companies that I am investing in, right? But that typically will not work for professional investments. So that's why today you also have very investors who are very thematically aligned. Okay, there are investors who invest in, say, health tech companies, the investors who predominantly invest in retail tech companies. So that seems to be happening as well, because the world is complicated. It's very difficult to say that one investor can understand, analysis, and analyze the fortunes of a company starting from fintech to health tech to everything else, right? Unless they are very large funds where they will have their own verticals for each of these teams for each of these verticals. Okay, and then you can do probably that, right? But we are not. So when you talk about genetics and SaaS, it is as much about you educating the investor as about the investor trying to understand your business. Okay, so you may need to be very focused in the investors you go to who have already done investment in the space, or who have teams who can understand your proposition. Okay, otherwise you will be spending a lot of time educating the investors, and I don't know whether that is something that you would like to go through, right? So select the investors and then have the pointed conversations with them. That's what I would recommend.
Thank you, sir. Thank you for that. So there's one more question that has come up. So this is a very generic question, but I still think it has some relevance. How do we know when should we pivot or persevere with an idea? This is Mr. Murlidhar has asked this question. So how do we answer this, sir?
Yeah. So number one, pivot can happen because of many reasons. Okay, you need to, number one, when you start, you have obviously a lot of conviction about your idea and your odds of success, and then you continue to do things. But I am of the belief that every opportunity has got a certain opportunity window, after which that opportunity is either not there, or it is not as relevant as what it was when you started. Okay, so there is a window in which you have to capture this opportunity. So if either your product development cycle or your early sales cycles have taken much longer than that, you would have this kind of a problem. So number one, you have to continuously revalidate your idea, and that is something that you can set it for yourself internally, right? So let us say that every quarter you do a 360 degrees, okay, as to whether if you were to start this company again, would you do that? Okay, you can ask that question yourself. Okay, I started this company nine months ago. I am down, I've done some things. Now, suppose I have to stand back and say that, I'm given this opportunity to start this company or the company in this particular space again. Will I do that? You have to be honest with yourself, right? And that will give you a clear answer whether there is a need to pivot or or you can continue where you are. Okay, that is very important, because so many things change around you. Okay, the environment in which you have conceived the business and launched it is constantly changing. Okay, and when this constant change, certain things become irrelevant and certain things assume more relevance, right? So you have to understand that, because you cannot control all of these variables, right? For example, there may be a very deeply funded startup that could have come after you have started, right? And they have gone probably much faster than you, because they got the money to burn. Okay, they have built a large team, they have built capabilities, and they've gone, and that. So now you have to decide whether this is a battle that I want to be in, or should I say that enough. Okay, let me either pivot into something else, or look at something completely different. Okay, so competition could be one reason. Technology changes could be another reason. You may want to pivot. Okay, what are your customers telling you, right? Your customer dropout is a very, very important metric that you will need to measure, right? If your customers are coming in fast, but then they are dropping out also fast, what does it mean? They do not see lasting value in your product. Okay, now what are they doing after they drop out? Are they going to your competition product, or they are going back to their old ways of doing things? You have to talk to customers. That's the only way to understand what they are doing and why they are doing that, right? So consistent and continuous revalidation is the only recipe I can think of to say whether you need to pivot or not pivot.
Understood. Thank you, sir. Thank you for that. So there is a very interesting question from Mr. Mukesh. Would you recommend a bank loan if available compared to raising external funding?
Yeah, I don't know whether bank loan is something that is readily available, because typically it comes with a lot of caveats, in terms of collateral and things like that. But debt funding is something that you can look at. Okay. Now, venture debt is something that is an emerging channel for funding companies, and many companies have chosen to take that, to do that. But to me, it is not a initial stage discussion. Okay. Because when you say venture debt comes with a interest rate expectation, right? You have to pay interest. Okay. And obviously you have to pay back the principal, or it could come with a convertible clause, partly convertible into equity at a later point in time. Okay. But irrespective of what the terms of that could be, you need to have cash flows in the business to be able to pay the interest. You need to have cash flows in the business to be able to pay the principal. And initial stage companies will not have that cash flow. Okay. So you are now, you do not have debt as an option at a very, very early stage in your, life cycle as a company, right? So you will have to look at the equity option, or the other option is convertible preference shares, right? I mean, this is the typical Indian instrument, which is called as CCPS. Okay, so it is compulsorily convertible preference shares. In a CCPS, what you do is you do not agree on a valuation today, right? You agree on a valuation based on the next institutional funding round, which could happen 12 months or 18 months down the line. Okay, you say that whenever an institutional investor comes in and he is assigning a valuation to the company, what I am investing today will convert at that value less some discount percentage that you may agree upon. You can say that 20% less than the institutional funding round value, right? So there are a few other clauses associated with that. You may want to check that out as well. So in summary, the options that you have are, besides equity, CCPS, which is compulsorily convertible preference shares, which gives you some of the flexibility that you're looking for, and a venture debt, but at a later point in time when you have sufficient cash flows to kind of afford that option.
Thank you, sir. I think that was pretty clear. So I think we don't have so much time, so let's just take one last question actually. So there is this one question from Mr. Avdesh Kaitan. So would SiriusOne look at companies in defense tech with an age company exceeding over 10 years? So he's talking about an old company, and would SiriusOne actually be interested in investing in such a old company? Or yeah.
Yeah, actually, the Avdesh, the point is that there are two angles on which you have to look at it. One is about the regulatory requirement. As a fund, as a venture fund approved by SEBI in India, we are mandated to invest in startups. Okay, and a startup is something that is very well defined, in the by the government, organization. So you'll have to go through that definition of a startup. If my memory serves me right, it is companies which are not more than 10 years old. I think it was earlier 7 years, if I am not mistaken. Probably they increased it to 10 years. So you will have to check that out, right? So that could be one constraint in whether a fund like ours can invest in a company or not. It's about how old that company is. The other option is, if this company has been there for 10 years and it is developed a product or an idea which is, of recent origin, that can be started as a separate company. Okay, instead of burdening it on the old company which is already there, you could actually have a company with that particular idea or the intellectual property, and then you go out for funding for that particular new company. So that is possibly something that you can think of.
Thank you, sir. Thank you for that. I hope that answered Avdesh's questions. So there's more questions coming in. I would like to answer a few of them. Is that okay with you, sir?
Yeah, sure. Maybe another 5 minutes. That will be okay.
Sure, sure. So there is one person, Mr. Dharma, who's asked this question. When we are a technology company, would it be essential to approach only investor who invest on technology earlier? Can can investor put money in competitors? Like I think he's saying on the senses, can there be conflict of interests when someone is already invested in a previous technology, and if there's a new technology coming in,
Okay.
investor be looking into it?
Okay, let me try to understand this question, because technology is a very broad term, right?
Yes.
And yeah, so if it could even be vertical. If you look at the food delivery business, there are about 20 odd companies when we started. Okay, about a few years ago, right? And today probably there are about two or three which have survived, right?
Mhm.
And there have been investors who have backed all of those companies. I mean, I don't think investors did not walk away. They all kind of did it. So the question is, can the same investor invest in two companies in the same vertical, or maybe using the same technology? That's the way I read it. Now the question is, what is your stance as an entrepreneur to that? Okay, you have to have a point of view as well. I
Mhm.
have known entrepreneurs sign a deal with investors saying that once the investor invests in my company in this particular vertical, the investor is precluded from investing in another company in the same vertical. Okay,
Understood.
that is up to you to negotiate at the point of investment and then agree with the professional investor. And if the professional investor agrees, I'm sure he will be good to his word. Okay, so there's no problem with that. But if you look at it from the investor side, there could be investors who actually bet in the same sector across companies, and that is quite possible. We have known that happen in many companies, in many VC firms. One could be geography. If I am investing in a company in the southern part of India, that does not prevent me from investing in another company working in the same business, say in Kolkata or somewhere else, right? So I may be working with the idea that at some point in time I may be able to bring these two companies together and have a larger market size in my portfolio, right?
Mhm.
And that is quite possible. And there could also be another way of looking at it, where an investor may have two different competing technologies to achieve the same objective. Okay, and then he may say that, I do not know which technology will finally have traction in the market, but I want to take both bets. Okay, so I'm sure one of them will probably fail, but I'm willing to live with that. So some investors take that kind of a approach to this kind of problems, where they are very convinced about the objective, but they do not know which road will take them to that objective. Okay, so they may be betting on both of them. Okay, so now I think the ball actually finally comes back to the entrepreneur, if they are comfortable doing that, and they want to put that as a clause in the discussion, so that they can either live with it or they can preclude that.
Thank you for that. So there is another question from Mr. Afsar. So he's jumping straight to business actually. So he's saying, can you please tell something on how should the term sheet be? So if it should not be a trap for either one of them. So some important points if you would like to share about the term sheet.
Yeah, I mean, see, number one, the term sheet is not a binding document. Okay, on both sides. It does not mean that an investor cannot back out after giving the term sheet. It does not mean that the entrepreneur cannot back out after accepting the term sheet. So it is not a binding document, and it is until it is replaced with a proper shareholder agreement, etc. It is a intermediate document to kind of hold place. Okay, and there could be terms coming along with the in the term sheet, which ideally the entrepreneur should not be surprised at a later point in time, when the actual shareholder agreements are being drawn out, because the term sheet should have covered all the salient points. Okay, term sheets can go from a simple one pager to 3 or 4 pages. It cannot be the entire shareholder agreement, for example. It only tells you the salient terms of the investment. If there are tranches in the investment, what are those tranches? And if there are tranches related to milestones, what are the milestones? If there is a valuation that has been agreed upon, what is the valuation? It will tell you what is the current cap table of the company and what will the cap table look like after the investment has happened. Okay, these are the standard things that you will find. Okay, and the timelines for these things. When is the investment expected to happen? And the standard terms could be all the things that you will see in the in the shareholder agreement. Could be right of first refusal, right of first offer, all this drag in, and all the standard clauses that you will see, which are which are not to be surprised. Entrepreneurs should not be surprised with. But I think the salient ones are these. Look for specific conditions which says reserved matters, because some of the investors put in as the reserved matters. See, typically the Companies Act says that there are certain ownership stake percentages which an investor should have before they can exercise certain rights. But what is happening is, in the term sheet, typically with much lower stakes, the investors will try to exercise those rights. Okay, and that is, they feel it is correct because they're taking a much larger risk. So they will say, for example, that the company cannot borrow more than 10 lakhs of rupees, without express approval of the investor. That could be one clause that you may find in a term sheet. Okay, the company cannot incur capital expense above a certain limit without getting approval from the investor. So they may have very specific clauses which will be tagged on to the term sheet, saying that these are reserved matters. When you say reserved matters, it means that the investor has to give explicit approval before the company can go and do something. Okay, so look for all of those items and ask yourself whether you're willing to live with those clauses or whether you have to negotiate those clauses. Okay, so that is important. So I would say that you should not be surprised with about 80% of the clauses because they are standard. The ones that I mentioned about the investment, the tranches, the timelines, the valuations should reflect what you actually agreed upon. Plus, reserved matters, something that you have to go clause by clause to understand if there is something that you are not comfortable with, and have a good discussion with the investor. So either take it out or modify as the case may be, and then do it. I think one of the things that you may want to do is to have some professional help you, because this is where the investors have a upper hand because they have professional help, whereas the entrepreneur does not. Okay, so it is not going to cost you a fortune, even if you have to go to a chartered accountant or a legal professional and say that hey, this is the agreement or the term sheet that I have been given, what is the meaning of this? So you can just go with that kind of a thing, just a 1 hour appointment or 2 hour appointment with somebody like that. I think it will clarify a lot of things for you. I would really recommend that. It is money worth spending.
Yes, sir. I completely agree with you on that sense. And I think I urge people also to look into that legal aspect as well. Sir, I think that is all the questions that we have at the moment. And I am sure that, every question was answered. But if not, okay, just one more question. Okay. So if not, sir, is it, can I ask them to like send a question over to you,
Yeah.
maybe on your LinkedIn or maybe on other platforms,
Yeah.
and you could answer the same for them.
I will do that.
So that's something that everyone can take a note. And yes, sir. So thank you so much. It was very informative. It was actually some things that was like, eye opener as well. And I hope all the audience also feel the same. And like you said, it is always going to come back. We hope that you can always come back to NASSCOM and spread the joy and also more knowledge to us. And yeah, we'll be hoping to see you soon, sir, about
I
that.
would really love to do that. In fact, I would love to do it face to face. It makes, I mean, I know that there is somebody out there. I can't see any of them.
Yes, sir.
So, it is not a very, thing that you would like to do, because, you want to interact with people, look at them, look at their reactions, talk to them and shake hands and so forth. So hopefully it can be a physical event as well.
Hopefully, yes, sir. So yeah, we'll make a physical event, sir. On that note, should we like close this workshop for now today, sir?
Yeah, absolutely. Thank you so much for giving me this opportunity. Yeah.
Thank you, sir. Thank you so much. And thank you all the audience for your interactive questions. And we hope to see you soon in the next coming talks from NASSCOM COE. Thank you.
Hey, have a good time, guys. Really do what you're doing. I really appreciate the time and effort everybody's putting into the startups. Yeah.
Thank you, sir.
Go out and win. Yeah.
Yeah.